This is a topic that I'm actually really passionate about because I get this question all the time. Everyone is asking me, should I have an S Corp for my business? And I'm going to give you an opinion that is contrary to most CPAs that you're going to listen to, but it is totally worth your while. I'm going to talk about 3 reasons why you should not use an S Corp for your business, especially if it is real estate. And I'll tell you right now the main reason that people suggest S Corps and why it doesn't matter. And that is for what we call in the CPA world, self-employment tax certainty. So what this means is when you are self-employed or you're drawing a wage or you have a business, generally you're paying yourself a salary, and not only do you have to pay income tax on it, which is what you file your 1040 at the end of the year, but you also have to pay the Social Security taxes, which is an additional 15.3%. And so a lot of people use S Corps because they will pay themselves a salary, pay the self-employment tax on it, and then the additional amount is not subject to self-employment, only income tax. And so that's the basic structure if you have a business versus if you just are on a Schedule C as a sole proprietor and all of your income is flowing to you individually, all of it is subject to self-employment tax. So that's the main reason that people will suggest S Corps. And I'm going to tell you at the end of the video how you can get around that without an S Corp and all the pitfalls that come with S Corps. So here it goes, 3 main reasons. The first one, and this is absolutely critical for real estate, and that is that you cannot get basis for third-party debt, okay? So let's show you how this works. So let's say that you buy a property, and I'm going to keep this simple, okay? Let's buy a property for $100,000. And because you want to use other people's money, you only put $20,000 down, and the rest is finance. So in S Corp world, your basis in this property, if you had bought this property through an S corporation, is $20,000 for the cash you actually put into the S corporation to acquire the asset. This $80,000 that you got from the bank or a private lender or wherever else that isn't you is not part of your basis. And this is critical because if you watch the other videos, you can maximize deductions with real estate through cost segregation studies, doing depreciation, and all kinds of other strategies. So what ends up happening is if you take out losses through cost segregation study, and let's just say you do a cost segregation study in the first year, and let's just say for simplicity that your deduction is $25,000 and all your other costs are break even. So your net taxable loss is $25,000. So if your net loss from this operating business was $25,000, everything else was equal, you have a $25,000 taxable loss, but your S Corp basis is only $20,000 because that's the cash you used to acquire the asset. You can't use the third-party debt. Then you have a suspended loss for the difference of $5,000. So you don't get to use this loss. That is a huge pitfall. You do not want to be in this situation. And I understand that I simplified this a lot and you may not do a cost seg on a property this small, but imagine it's a bigger property. Imagine it's $1 million property. Imagine that you refinanced and took cash out, which also reduces your basis. I actually had a guy that had owned properties for many years and his CPA had him put them in S corporations. And then he did a 1031 exchange into a larger property. And he was coming to me and he was asking, hey, I'd like to do a cost segregation study. I looked at that and I said, hey, what is the point? You're not even going to get the deductions because you don't have enough basis in your S corporation. You would be wasting money doing this cost segregation study. In fact, you're actually better off if you blow your S corporation status, pay the tax on the 1031 exchange, and do a cost segregation study because those deductions that you'll now receive will offset the capital gains that you'd recognize on the 1031. Because if you stay in the structure, you're not getting any deductions. So do not end up in that situation. Do not use S corporations for real estate. And most of the time, many times, now there are exceptions, you won't want to use an S corporation. And let's go into the next 2 reasons. Reason number 2 why you won't want to use an S corporation. A lot of times when you are starting a business and you're figuring out the entity type and the structure, you're really just trying to look in your crystal ball and determine what the future is going to hold. And many times what actually happens and what you think is going to happen are not the same. So you want a structure that allows flexibility for a lot of different possibilities down the road. This pitfall has to do with selling your business or buying into a business that is an S Corp. And this is important because you don't get step-ups. In other words, you don't get additional depreciation if you buy into an S corporation or someone buys into your corporation to take additional depreciation deduction. So I'm going to show you a quick example on what I'm talking about here. So you bought a property for $1 million. Let's say this was 10 years ago. Now we're going to say the value is $2 million. And although the property has increased in value through various reasons, inflation being one of them, you want to do a refresh and you want to improve the aesthetics of this building and attract new tenants and increase the rents further. So you need cash to do this. So what you do is one of your friends says, hey, I want to get into real estate. I actually have cash sitting idle. I could give you some cash for this. So let's say that they give you $500,000 and they want to be a partner in the entity. So now they're a partner in this entity. And so they've put in $500,000 of cash. The building was worth $2 million. So this isn't your cost. This is the value today. So the total value when they put cash in the entity for these improvements is $2.5 million. So now what that means is your new partner has 20% of the value of this entity or a 20% interest, or you have an 80% interest going forward. Now let's look at what this would look like for depreciation in S corporation land. So if $800,000 of your $1 million original cost is depreciable, that means $800,000 divided by, we're assuming this is residential property, so divided by 27 and a half years would be about $29,000 in depreciation deductions each year. For your new partner that owns 20% of this, that means 20% of $29,000 would go to them, or about $5,800. So your new partner that has a 20% interest now is $5,800 of depreciation deduction. That's an S Corp world. Now let's take a look at how this looks in a partnership situation. So not an S corporation, but this is probably an LLC with multiple members. In this scenario, you can actually make an election to step up the basis of the property for the partner who purchased an interest. So now you're going to start basing for the new owner the depreciation off that $2 million value. So let's take a look at this. So we're going to assume that the same ratio of our $2 million value is depreciable. So 80% or $1.6 million is a depreciable asset, still over 27 and a half years. So what this means is now we have $58,000 a year of depreciation, or twice what we had in S corporation world because of this step up. Now, this additional step up only applies to the new partner coming in. I'm doing this in total just to show you for simplicity how this works for the new partner and why it's such a big benefit. So now I took 20% because the new partner that you have has a 20% interest. So their depreciation deductions, because now it's based on what they paid for the partnership, they actually just doubled their depreciation deductions because this was set up as a partnership and not an S corporation. Okay, hopefully that made sense. I'm going to go into number 3 of why you don't want to use an S corporation, and that is because you can't get assets out of an S corporation without causing taxable income potentially. Let's just say that you bought a property for $100,000. Now let's say it's worth $150,000. Well, if you want to dissolve the S corporation for whatever reason, maybe you're in California, you're paying additional filing fees, or you're just filing for this entity where you're the only owner of it, or maybe you want to add in a partner and you want to get some of the benefits that I talked to you before, or maybe you want to do a 1031 exchange and you're limited by the basis issues that I discussed in reason number 1 that you don't want to use an S Corp. Whatever the reason is, you want to get it out. What happens in an S corporation situation is when you take that property back, now you have to take it out in what's called a distribution at the fair market value. So it comes out as if it's worth $150,000, but your basis, because you paid $100,000, if we're assuming no depreciation deductions for simplicity, The difference is 50,000 of what I'll call built-in gain. That amount now is subject to tax, even though if you were the sole owner of the S corporation and now you take that property back and put in your own name, so you take it out of the S corp, so you're still essentially the only owner, but now you're paying tax on the difference between the value at that time of the distribution and what you paid for it. Whereas if you have it in a single member LLC or in a partnership and you do that same thing, it comes out tax free. So that gives you a lot more flexibility to avoid S corporations in that case.